Hello everybody. So today I want to talk about OSCR. This video is entitled OSCR makes 0 cents on valuation. OSCR reported an amazing Q1, and it looks like all of the fears regarding the slowdown, all of the fears regarding the inability to calculate the medical loss ratio, they are slowly being abated. And I listened to the entire call. Management was very, very, very confident that the issues of Q4 2025, may actually not repeat themselves. At least that's the stance I got on the call. And of course, make no mistake, the valuation makes 0 cents even with the stock having doubled since March 27, roughly. This stock is up 90%, 90 plus percent since March 27, for a stock that literally had nothing to do at all with the Middle East conflict. Nothing to do at all with the Middle East conflict. This market has no idea how to value this stock. At one point, it valued it close to $40. I don't show it on the 5-year, but at one point it was close to 40. At many points, it valued it at 25. And, for the longest time, it valued it at 5. The market has no idea how to value it. But my spreadsheet, is kind of giving me, stupid numbers, I guess is the way I will say it, stupid numbers. So if I use the seeking alpha number for debt and cash, I get an EV over GP over RG of 0.001. But actually, if I were to use the numbers discussed in the call in my cash column, well, turns out there's nothing I can do because they tell me they have 8.1 billion of cash and investments. And if I put 8.1 billion in there, I get a negative enterprise value, and I can't have that. Now, of course, this cash, quote unquote, is not their cash. It is the float. It is the money from the premiums that is sitting there until the premium is eventually lost, as reflected through the medical loss ratio. This premium is eventually lost to pay for care. And so you lose, they say their guidance, they say they expect to lose about 83% of the premiums they get in. They lose 83%, and then another maybe 15% on SG&A, and then whatever's left is your margin. And that's why I have EBITDA margin on there at 2%. But the market just absolutely does not believe or does not give any credit to this business. The TradFi analyst must be all about trad health, and even then you could make the debate they don't like UNH either. I don't really know if the market just likes anything outside of AI right now. It kind of feels like they only like AI right now, and you have super high growth stocks who are being left for dead, and OSCR is one of them. Financial results year over year was 53% revenue growth, 53% revenue growth compared to the quarter prior. They are still reaffirming their full guidance. And so last time I had calculated at 61%. I'm going to keep that 61% number because of the optimism. But they're guiding for up to $19 billion in revenue in 2026. We are at $13 billion. And by the way, I think all of these numbers are heavily sandbagged, as evidenced by the optimism of management on the call and the analysts kind of picking at them and saying, oh, why are you being so negative about this metric or that metric? They keep guiding, to give you an example of that, they keep guiding an MLR, medical loss ratio, of 83% roughly, even though the first quarter they had a 70.5% medical loss ratio. Of course, they qualify that statement and say, oh, it's typically the lowest in the first quarter and the highest in the last quarter as people rush to use their benefits. But nonetheless, that delta is huge. I mean, we're moving from 83 to 70. There's a 13% difference. I think they are doing better than they thought on the medical loss ratio. And of course, just a small move down from that guidance, right? And you can have EBITDA margin double on top of that. And then when your rule of 40 gets higher, and my gross margin, of course, get much higher after that. And so I get even twice as cheap of a stock. So, and even if you look at, for example, their earnings from operation, they expect between 250 million and 450 million. If I use 450 million, which I believe is sandbagged, if I use that, I get a price to EBITDA of 13x. And price is the key word here. Price is a key word. Some of that float is always going to be on the balance sheet, but it's waiting to be paid out. But some of that float is also theirs. But anyways, for the sake of being conservative here, I'm going to assume none of the money is theirs. I'm also going to ignore the debt, and I'm going to assume none of the money is there, and I'm just going to use market cap. I'm just using market cap, and my metric then is a market cap over gross profit over revenue growth. If I take market cap over gross profit over revenue growth, I get a 0.049, which is dirt cheap for my spreadsheet. This is twice as cheap as HIMSS. This is top 2, I guess. Yeah, top 2, top 3 maybe. I don't have. There's 200 rows. I didn't check, but it's like top 2 or top 3 cheapest, and that's without taking, of course, enterprise value. If I take enterprise value, I could potentially get to a negative enterprise value, but that float, of course, is waiting to be paid out. So that's not exactly how you do it. Insurance companies are, you have banks, you have insurance companies. They're an entire different ball game to analyze. But this looks cheap. This looks too cheap. Let me move on to some qualitative comments from the call, qualitative takeaways from the call. They're rolling out smaller states like Arizona, and before they do a full rollout to the entire state, they like to test customers, make sure the customers are going to be profitable. Their members tend to be in big city centers. CEO outright saying that members in big city centers are healthier than members in more rural centers. And so, that kind of makes you think about a bunch of people on X who talk about, living in the country and it being healthy. The data apparently doesn't suggest that. They launched an AI agent to get drug prices and to get information about services, to get information about generics. This is a very big deal in my view. This could lower their medical loss ratio by quite a bit by steering people towards cheaper alternative, so that perhaps once their copay runs out, perhaps OSCR is on the hook for less of that amount. They are launching a neutral shopping platform where other providers can also sell their products. And so I don't know how they're going to monetize that, but they're launching their own type of marketplace. Apparently, one analyst was pretty excited about that on the call. We'll see. They said this is not going to be material until maybe 2027. They talk about iCry, which is selling direct to employers, talking about how whatever sale they get through that is super attractive because it's way less regulated. There's less regulatory requirements compared to the ACA, and so they find that very attractive. And of course, they are a main provider of plans under the ACA, the Affordable Care Act, and none of their plans assumes a return of the subsidies, which could be a major catalyst for OSCR with the midterm coming up. Maybe somebody talks about subsidies again. And so if that were to happen, I think that could be a good catalyst for OSCR. My view on this is that the market has no idea how to price it. My own spreadsheet has a hard time how to price it. What I can tell you is that it's way too cheap. You have a lot of technical analysts on X who say that technically the stock looks very bullish. But from a fundamental standpoint, I see why this stock could win. They use AI to reduce staff, to reduce expenses. Right? If you reduce your expenses, you increase your gross margin, you increase your EBITDA margin. They use AI to reduce the spend from their members. And if you reduce how much of members spend, you reduce the reimbursement that OSCR has to pay, or you help your members not reach their full deductible amount, and then OSCR doesn't have to pay anything. Right? If you help your members not spend your entire amount before the deductible is reached, they may never reach that deductible. And then your Q4 looks much better than what you anticipated it would look like. And they're very agile. They're a small company, a much smaller company compared to traditional insurance, traditional players. And they're talking about, of course, there's a change in consumer habits, especially with Uber, with DoorDash, with a lot of gig workers. A lot of those people are very interested in catastrophe-oriented plans or catastrophic plans. And, I'm guessing the CEO was referring to their bronze plan, but they may even have a plan even more even more extreme for catastrophic. But it's likely referring to their super high deductible plan. That's what I think such plan is, right? Anyways, from my standpoint, I don't invest too much time, deep in the weeds studying this stock, because the valuation is enough to compel me. Like, I'm compelled based on the valuation, and I'm willing to invest in an industry that I very much dislike, which is the health insurance industry. I'm willing to invest in it because this is the cheapest stock I can find in a universe of growth stocks all over the place, right? So, like, in my style of investing, I look for both high top line growth, 61% next 12 months is very high top line growth, i.e., real adoption by consumers, real adoption of a company's products by the consumer, and revenues don't lie. So real adoption, but cheap. Each unit of adoption, I want to pay super, super cheap. And there's no stock out there that gives me, I mean, there's one, and there's probably more, but I haven't found them all. But you're paying so cheap that percentage point of growth, so cheap, 0.049. So I love it very much. And this stock has a lot to please a lot of people. With a price to EBITDA of 13, it could please any value investor just as much. So anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.